The economy is down and yet stocks are up. I'm going to show you today what's happening with this disparity in between the two. It is really critical for anybody waiting to put down cash right now to pay attention to what I have today. Right here, we have the GDP falling 0.9% in the second quarter. This is the second straight decline, and not a recession, but a strong recession signal. So right now what we are seeing is they're throwing away some of the definitions of recession because that would look really bad, right? If they tell you it's a recession, that's a self-fulfilling prophecy, and therefore you might spend less, you might go out less, and so on. So they simply have to keep it hush hush. So that shows you the simple data, but I'll break it down further. In fact, I have several charts to show you here. Looking at it quarter over quarter, you can see the red. That's showing us that it, in fact, had dipped down into a negative. The last time we saw this was early in 2020. And having two consecutive quarters, we also saw that during the financial crisis. So if we break down the second quarter GDP and look at the actual data in these two charts, this one and the following one, you could look at it on, having more detail, because just seeing minus 0.9%, it's not good enough in my opinion. You could look right here, just showing you the total, but also what else has happened. Housing investment down. People aren't buying as many homes as they were, even late last year. What was up? Big time right here. Exports. Exports were the big one. Consumer spending was in fact up as well. But are people spending more on gasoline and food? Absolutely. Quarterly GDP by component breakdown. Just to give you another look at this from 2019 up into the present. And the only one I wanted to highlight was this purple area, which is exports. So you could just take a look at what has happened here. That has really saved the GDP from looking much worse. Higher borrowing rates, a consequence of the Federal Reserve's series of rate hikes, clobbered home construction, which shrank at a 14% annual pace. Government spending dropped too. And that's why I put this here, because when you look at the government spending, they want to, do all these new infrastructure packages and, all these different things that are coming out, which I'll talk about more in a future video. Getting approval from Congress to spend more money to reduce inflation. That's right, makes a lot of sense. But this right here is always a cycle. And the more they pump out, they're going to have this try and stimulate different businesses. It doesn't usually stimulate, like they put $1 trillion of stimulus out there, and that trillion doesn't go to the people. It goes to the big businesses. It goes to line their pockets. It goes, foreign corporations, all this nonsense. You get a few breadcrumbs, and, that's just the way it goes. So I think what's happening here is that we have increasing rates that is putting real, dampening the economy as a whole. But what they're trying to do is to create a soft landing. Now, they cannot create a soft landing. It's impossible. But of course, they'll tell you that this is what it's all about. So I thought it was just interesting to see the data and the way that they present it to people, and they can twist it any which way they desire. In fact, this is an article out of the Washington Post, the 8 economists who decide if the US is in a recession. Did you hear what I just said? Yes, that's right. Because the NBER, or whatever you want to call it, this institution here is officially going to label if it's a recession or not a recession. And so what they indicated during the financial crisis was 12 months ago, this is the way they did it. 12 months ago, the recession started. So it took them literally a year to tell the public officially it's a recession. If that isn't just odd, I don't know what is. Like, why? Why does it take a year to figure that all out? You and I knew already. And so what's interesting about this is that we start to see reverberations from the financial crisis. Take a look. You are watching two lines on this chart. The green is the continuing jobless claims, okay? And then the red is the initial jobless claims, and those have started to move up. You can see that. Isn't it so interesting? We are at a level going back to December. Some point out, as I covered in a previous video, that it all depends on the survey, because remember, they're not counting each and every single job. This is based on survey data. And so they estimate it. But you look at a different survey, okay, the household survey, there's the establishment survey, the information they share with you and I, but there's the household survey. There's other ways to look at it, essentially. And when we do, we see that, hey, wait a minute, maybe the job situation isn't so strong. But if we're going to look at the U3 unemployment rate, we're going to get a different picture. This is showing us, going back from 2020 up until the present, U.S. employees on non-farm payrolls. That's the green line. Everything's looking good for jobs, right? No worries. But then you see the initial jobless claims. Wait a minute. Where have we seen this before? Right. This chart here is leading up into the financial crisis. So it's from 2004 basically into 2009. And the last time we saw this, it was 2006. So a different situation, obviously. 2006 is not like 2022, but the point remains that we are watching some wild stuff happening. Now, what happened in 2006 was same as 2007, basically, and almost into 2008, where they refused to acknowledge a recession and refused to acknowledge economic weakness. This goes basically everywhere with the job situation, but it's also in real estate as well. The housing slowdown we've been anticipating for months is here. The big picture, and this is a big one, is that home sales are slowing down, and some of the 2020 hotspots, the hottest or Zoom towns, as they call them here, sleepy areas where remote workers pushed up real estate prices, are already seeing price drops. Why? Because these are towns that, I don't want to say they're not desirable, but for the average city folk, this is not the place they want to be living, but they needed that extra bedroom or maybe 2 bedrooms. They needed the room because they couldn't live in their, 600 square foot apartment and have 2 people working from home. So they went out and they were able to take that condo, convert it into a house, and it was all good for some. And so that's changing right now, okay? And that's where we see it. I think at the fringe, as I always say, at the fringe, we start to see the real deal information. In fact, we're looking at it, pending home sales fell 20% in June versus a year earlier as mortgage rates soared. That's a big one, okay? Now you're looking at, as it pops up as I record this, Hong Kong's index, stock market, getting pummeled, 2%. Now that's interesting because the reports I have seen for the US right now is that we will see, by the time you're watching this video, we will see a big squeeze upward. We'll see if that's the case. US yield curve flashing more warning signs of recession risks ahead. When you look at all of this, I think it would be interesting to see how this affects people as a whole, because we've seen this yield curve, it inverts, it flattens, and what happens overall? That it's just going to be topsy-turvy until the Federal Reserve commits to stopping of this increasing interest rates. The public doesn't want this. They want stability and security. They don't know what the Fed is doing. They just say, I don't know, but when I go to the store, I don't want to have to pay more for my, whatever, Coca-Cola or whatever. So this is important because people are being affected by all of this. It doesn't matter if the yield curve is, flattening or inverting or what have you. But, when you look down the line at all these things and it just breaks down to, okay, what's happening with the average person? And they're just getting smoked right now. They're getting smoked. That could be changing. Okay, we'll see what happens. I think it's important to track the data, and of course, I will do that for you. If you want to track that data with me, all you got to do is hit that subscribe button, because when you do, you are going to be notified of all these videos, and I will track each and everything. Like anybody who's watching this channel regularly knows, I'm constantly getting all that nitty gritty. Okay, look. Don't expect big consumer brands to lower prices anytime soon. Coca-Cola, Unilever, Kimberly-Clark says price increases help them cover cost inflation, but they are watching how consumers respond. So they've all done this. Every company has done this. You're seeing it on simple food items, pizza and whatever, all the street foods and things, but everything all along the way. People have talked about how far this has gone, and as a result, some of these companies have been closing up shop. In this case here, they're just talking about Etsy closing San Francisco offices. This is just another place. Some are leaving places like San Francisco, New York, New Jersey. They're moving out, but sometimes they're just closing up shop and then they're doing a whole remote thing. So it depends on the business, depends on that. But we are definitely seeing major changes. And I've also noticed this personally. Everybody into the hotel pool. That'll be $200. Some hotels now charge swimmers and sunbathers to reserve a basic poolside lounge chair, often with a few other perks. So it's not just about this pool or hotels or what have you, but I have noticed this, and I want you to please share in the comments below. Something that used to be included, that used to be free, or was a very small fee, now costs some money. Okay? Just like you're using this example here. Yeah, you're going to go to the hotel and they are going to charge you $100 per night, let's just say. But you got to pay the hotel fee. And then you got to pay for this thing. And now $100 a night is $150 a night. Oh, but it's $100 a night. It's just this fee, this tax, and that tax. And suddenly it's $150. So you look at that and you have to figure out that's not just a little bit of inflation. That's pretty significant. Okay, and we watch this on food products. You look at it on just about everything. Remember when, a flight, if you looked at a flight, now the taxes and the fees on a flight are equal to or sometimes even greater than the cost of the flight itself. I mean, that is just strange. It's weird, but that's the way it goes, all right? Okay, I want to thank you all for being here. Don't forget to subscribe to the channel. I'll see you on the next one. Take care.